welcome back to the vlog. We are going to jump into chapter 8 today, how to pick a stock. Picking a stock may seem like finding a needle in a haystack, but there are many different techniques that can be used to facilitate the search. Many different factors come into play when picking a stock depending on the individual trading style and risk tolerance. Discretionary day traders using level 2 quotes and order books as a basis for placing trades usually look at top gainers and losers for the day to find stocks with the greatest volatility. Systematic day traders employing trading systems may instead look toward technical indicators and chart patterns to identify stock with upcoming volatility in advance of the rapid price movement and volume. Let's move this closer so you can better hear me. All right. Hopefully that'll be better. All right. Systematic day traders employing trading systems may instead look toward technical indicators and chart patterns to identify stocks with upcoming volatility in advance of the rapid price movement and volume. In this section, we'll look at some common techniques used for picking stocks and some other considerations for day traders. Top gainers and losers. The most important criterion for many day traders is a stock's volatility. After all, it's impossible to generate a profit from short-term trading without rapid price movement throughout the day. Top gainers and losers lists provide a great starting point for this type of day trader. By looking at pre-market volatility, traders can identify stocks that are likely to experience big swings during the early morning and late afternoon sessions. The stocks on these lists are usually being driven by fundamental events such as earnings releases, analyst reports, and other factors. Although the movements are subject to technical levels, these lists can be found in a variety of different sources, ranging from brokerage platforms to financial portals. For example, finviz.com, a popular financial portal, provides a detailed list of the top movers throughout the trading day. The website also provides insight into what is driving the moves, including new highs, unusual volumes, or other indicators. A common contrarian day trading strategy that's used to capitalize on these movements early on is known as fading. When using this strategy, a day trader may wait for a stock to rise to a key resistance level and then short sell the stock as it moves lower off of it. The opposite trade could also be placed, whereby a trader buys a stock reaching new lows as it approaches a key support level. In general, the strategy is aimed at buying into oversold conditions or selling into overbought conditions in order to profit from a regression to the mean. Technical indicators and overlays. Technical indicators are the lines that appear above or below the price on a technical chart, providing some insights into where prices are headed in the future. For example, the relative strength index, or RSI, provides a visual indication of price movement over time. Technical overlays are a type of technical indicator that appears over the top of price to show various trends in price over time. For instance, a moving average shows the nth average closing price and applies the value to the current period. Technical indicators have several different uses. Number 1, confirmation. Technical indicators provide confirmation for various other forms of technical analysis. For instance, a day trader may identify an ascending triangle pattern and confirm a breakout by looking at the MACD crossover. Number 2, direction. Technical indicators provide an indication of current and future trend direction. For example, a day trader looking to trade in the same direction as the prevailing trend may look at moving averages to gauge direction. Alerts. Number 3, alerts. Technical indicators alert day traders of potential opportunities and hazards. For instance, ebbing momentum could indicate that trends are changing and that it might be a good idea for traders to get out of any position. Technical indicators provide limited insights when used on their own, but by using them in conjunction with other forms of technical analysis, day traders can dramatically improve their odds of success. The key to success when using these indicators is understanding exactly what they are showing, momentum or trend, the most important levels to watch, 70 and 30 for the RSI. Personally, I go 80 and 20 just to be even more solid, and their limitations. Some of them are only useful in trending markets. Oscillators. An oscillator is a type of technical indicator that are banded between two extreme values that are unrelated to price. That's important. An oscillator is a type of technical indicator that are banded between two extreme values that are unrelated to price. For instance, moving averages are a technical indicator overlaid on a chart alongside the price, but moving average convergence divergence, or MACD, is an oscillator with a value that varies between -100 and +100 regardless of the price. Day traders use oscillators in order to do things like measure momentum or identify upcoming reversals. There are two types of oscillators. Number one, centered oscillators. Centered oscillators fluctuate above and below a certain center line to show strength, weakness, or the direction of the price. The price movement. This type of oscillator often does not have an explicit range limit, but tends to gravitate back towards the center line over time. MACD is a great example of a center oscillator that measures the distance between two moving averages. The distance has no limits, but tends to gravitate towards the center line over time. And lastly, banded oscillators. Banded oscillators fluctuate between a defined channel to show when price levels reach extremes. Typically, the oscillator specifies low and high levels that signify oversold and overbought conditions respectively. The Relative Strength Index, or RSI, is a great example of a banded oscillator where 70 is a universal overbought level and 30 is a universal oversold level. There are three primary trading strategies that involve oscillators: divergence, crossovers, and breaches. Depending on the oscillators in play, day traders may look at all three of these indicators to determine where prices are headed over the coming ticks. Divergences are used to predict upcoming reversals in price by looking at instances of oscillators diverging from the underlying prices. When the oscillator is dropping and the price is rising, a negative divergence occurs that could foreshadow a bearish reversal. When the oscillator is rising and the price is dropping, a positive divergence occurs and a bullish reversal is more likely. The MACD divergence is probably the most heavily watched oscillator for this type of strategy, as it is fairly accurate in predicting reversals. Crossovers are used to determine a change in the direction of a price trend by looking at centered oscillators. When the price moves below the center line, a bearish crossover occurs and foreshadows a decrease in price. When a price moves above the center line, a bullish crossover happens and an increase in price is more likely to follow. The MACD crossovers are also widely followed in predicting upcoming changes and trends using this strategy. Breaches are used to predict when prices are getting too low or too high by looking at the banded oscillators. When the price moves past an upper band, the consensus is that the security is overbought and due for a correction. When the price moves below a lower band, the price is likely oversold. The market is likely oversold the security, and it may be due for a rebound. The RSI is the most popular oscillator used for this strategy, where 70 and 30 are the upper and lower bands respectively. The best way to implement these strategies in practice is to look at multiple oscillators at the same time and look for these bullish or bearish signals. In addition, day traders should also use oscillators or any other type of technical indicator in conjunction with other forms of technical analysis that can provide a confirmation of their sentiments. Let's take a look at an example. In Figure 22, BSX experienced a bullish MACD crossover at a time when the RSI was trending higher. The MACD indicator was also crossing above the zero line, and the RSI remained outside of overbought territory. By reading all of these indicators at the same time, a day trader may have entered in the position at the MACD crossover and exited the position as soon as the RSI reached an overbought level. Figure 23 shows the concept of divergence, which can be used to predict price reversals in the case of S&P 500 SPDR ETF. Between June and August, the MACD was trending lower at the same time that the prices were trending higher, which suggested that a reversal was likely to occur at some point. The prediction came true in August when the price gapped lower and the index fell from nearly 200 to 190 over a short period of time. The key to using technical, let's look at the chart. All right, the key to using technical indicators, as with any other form of technical analysis, is to always be on the lookout for confirmations. With many indicators pointing to the same direction, it's much easier for a day trader to justify entering or exiting a trade. Trades with fewer confirmations involve greater risk of a false breakout or breakdown. Volume. Volume is simply the number of shares traded over a given period of time. For example, a stock with a volume of 15 million has transacted 15 million shares throughout the course of the day. If the stock usually trades 10 million shares per day, the increase to 15 million shares may be due to good or bad news during the course of the day. Day traders will typically stick to high volume stocks since they make it easier to buy and sell at a good price, while also seeking out those experiencing higher than average volume as a potential catalyst. Volume is the single most important source of confirmations when using technical analysis, since it provides an idea of the strength behind the price movement. While it's difficult to tell whether a given volume consists of mostly net buyers or net sellers, lack of volume means that a breakout or breakdowns in other trends could be very short-lived and difficult to predict. Suppose that a company announces earnings and moves 10% higher in pre-market trading on very little volume. The lack of volume suggests that the 10% may not be all that significant, and the stock could actually move lower when regular trading begins. On the other hand, the same stock experiencing a 10% rise on tremendous volume provides a strong indication that the stock will open and trend higher for the day. Volume indicators can help interpret volume in the context of price, support, resistance, and other levels in order to improve the odds of success. There are many different volume indicators. Number 1, on-balance volume. On-balance volume measures buying and selling pressure by adding volume on up days and subtracting volume on down days. Oftentimes, day traders will watch for divergence between these trends and prices in order to determine potential upcoming reversals. Volume by price. Volume by price helps visualize the amount of volume for a particular price range while showing inflows and outflows by color. In general, day traders can use these levels to identify areas of support and resistance. Negative volume index. The negative volume index is a cumulative indicator designed to show when the smart money is active. In most cases, the odds favor a bull market when the reading is above the 255-day EMA and vice versa. Day traders can use these volume indicators in a number of different ways. High volume breakouts from trend lines or chart patterns provide confirmation that the pattern's predicted move will occur. For instance, a high volume breakout from a trend line resistance provides confirmation that the breakout is real and the resistance level has become a support level. A high volume breakout from a trend line resistance provides confirmation that the breakout is real and the resistance level has become a support level. The lack of confirmation means the day trader should probably avoid a seeming opportunity due to the high degree of uncertainty. Volume can also be used as a key indicator of trend strength, or whether trends are likely to reverse direction or not. When volume is increasing and prices are losing steam, traders might assume that the trend may be coming to an end over the near term. The opposite may be true when volume is increasing and price momentum is on the rise, which suggests that the trend remains both intact and very tradable for a day trader. In figure 24, on balance volume decreased between November and December. At the same time, the prices were trending higher. The divergence between volume and price action suggested that a correction might occur which eventually came to fruition in December. Confirmation. Waiting on the sidelines for a trade to materialize is one of the most difficult parts of day trading. Since missed opportunities can be very damaging to the psyche, traders often eagerly enter into a trade at the first sign of a breakout, breakdown, or other pattern. The problem is that these initial moves can sometimes turn into false breakouts or breakdowns, which quickly translate to losses on the trade when prices sharply reverse direction. Confirmations are technical indicators, chart patterns, volume dynamics, or other forms of technical analysis that provide evidence that an initial trending alert is translating into an actual trading opportunity. The day traders should look for at least one and ideally multiple confirmations before committing to a trade in order to avoid false breakouts and breakdowns. Volume provides one of the strongest confirmations for traders by showing the strength of a move. For example, a day trader may find a promising breakout, triangle breakout pattern that recently moved above the upper resistance level. A novice trader may simply purchase the stock after the breakout to capitalize on the opportunity, but an experienced trader may instead look for additional confirmations first. Without much volume behind the move higher, the experienced trader may not place the trade and avoid a likely false breakout. Missing the beginning of a trade, slight profit, or even an entire trade, break even, is a better outcome than a false breakout or breakdown or loss. By waiting for confirmations, day traders risk missing out on the beginning part of the trade, but can still profit from the remaining upside. Momentum. Volume is a great tool for determining when a trend is gaining or losing momentum, although the dynamics can be somewhat difficult to read. The key to using volume as a momentum indicator is looking at the direction of the volume by comparing it with price movements. On the one hand, accelerating volume would suggest that a trend is picking up steam and is likely to continue on course provided the prices are also accelerating higher. On the other hand, accelerating volume with decelerating prices could suggest the opposite dynamic, where selling pressure is intensifying and bulls are having a harder time pushing prices higher. The same price dynamics are true for decelerating volume, which is indicative of a trend that's about to reverse, if prices are decelerating at the same time. Okay, moving averages. Moving averages are the most popular type of technical indicator. By averaging prices over time, they enable traders to quickly determine where the current price lies within its historical context. These indicators also help smooth out prices in order to get a clearer picture of long-term and short-term trends, as well as serve as building blocks for more complex technical indicators like the MACD, which essentially measures the distance or gap between the short-term and long-term moving averages. There are three major types of moving averages. Number one, simple moving averages, or SMA. Simple moving averages are the most basic type of moving average, calculated by simply taking the mean of N prices, which is designated to show long-term trends in short-term charts. Exponential moving average, or EMA. Exponential moving averages are the most commonly used type of moving average, which calculate the average of all historical price ranges beginning at the point that the trader specifies. And number three, weighted moving average, or WMAs. Weighted moving averages are the third most common type of moving average, which is linearly weighted to ensure that the most recent prices have a greater impact than older prices. There are advantages, I like EMAs, there are advantages and disadvantages associated with each type of moving average. For instance, the weighted moving average is often choppier than the simple moving average. The weighted moving average is often choppier than the simple moving average, which can make it more difficult to discern market trends. The corollary is that simple moving averages aren't as quick to react to new trends as weighted moving averages, which makes them more of a lagging indicator and potentially less useful in fast-moving markets. In figure 25, the line represents the WMA, the red line represents the EMA, and the green line represents the SMA. The SMA is the least choppy of the three moving averages, while the WMA and EMA tend to move more closely with prices. Figure 25. Choosing timeframes. The most important part of using moving averages is determining the appropriate time frame. When looking for short-term trends, 5 to 20 period moving averages are best suited for determining where prices are headed in the short term. Long-term moving averages consisting of 20 or more periods are ideal for identifying longer-term trends and can be useful for gaining context when looking at short-term price movements. The most popular moving average lengths are the 20-day, 50-day, and 5-day moving averages, since they round numbers that represent psychologically important levels. That said, day traders may want to experiment with different lengths when looking at different stocks in order to see what works best for each situation. Traders may also want to use certain moving averages in conjunction with certain technical indicators. Using moving averages. There are many different ways that moving averages can be used to improve trading, ranging from simple trend identification to complex trading strategies. Moving averages are a great way to identify direction of a trend. By looking at the slope of the moving average, day traders can quickly determine whether prices are generally rising or falling over time. Changes in the slope of the moving average come as long-term price trends are beginning to shift direction, representing potential trading opportunities. But as a general rule, most day traders stick to trading in the same direction as the prevailing trend. The most commonly used moving average strategy is the double crossover, which looks at the dynamics between the short-term and the long-term moving averages. When a short-term moving average crosses above a long-term moving average, the strategy generates a buy signal due to the short-term trend change relative to the long-term trend. In the example above, the slope of the 12-day and 26-day moving averages provides a good indication of when a trend is starting and ending. A day trader may have seen the index's price relative to the average and made sure to stay long only between mid-October and early December, thus improving the odds of success with everything else being equal. The crossover between these same moving averages also provides a lagging indicator, showing when the trend has begun and ended. It's worth noting, however, that the strategy has limited effectiveness when the price range is bound. When the price is range bound. Finally, moving averages provide great support and resistance levels that day traders should consider when making trades. The most important levels to watch are the round number psychological levels of 10, 20, 50, and 200. Although different stocks may respond best to different moving averages. In many ways, these levels are a bit like a self-fulfilling prophecy, given that they only work because they are so widely watched by traders. Risks and other considerations. There are many important risks to consider when using moving averages. Moving averages are lagging indicators, which means they aren't useful for making snap trading decisions. For instance, a 200-day moving average may be sloping downward long after a price has begun to trend higher. Many day traders use short-term moving averages, such as the 10-day moving average, to mitigate some of these concerns, while longer-term moving averages are used to determine trade direction rather than specific executions. When using crossover strategy, day traders should also watch out for false signals that can occur in choppy markets. For example, within a sideways market, a short-term moving average may cross above and below a long-term moving average, generating a loss each time. Day traders use momentum indicators in conjunction with these types of strategies in order to avoid these situations and accurately identify whether an asset is trending or not. Elliott waves, Fibonacci, and more. All right. Elliott waves, Fibonacci, and more. Technical indicators and moving averages provide day traders with a great starting point for identifying entry and exit points. But there are many other techniques worth exploring as day traders gain experience over time. Elliott waves were developed by Ralph Nelson Elliott to explain the movement of asset prices in response to underlying market psychology. At its core, the theory suggests that the market moves in predictable patterns consisting of impulse waves and corrective patterns. Traders can decipher these patterns and use them in conjunction with other forms of technical analysis in order to make more informed trading decisions over time. In Figure 27, Elliott waves from various time frames are plotted on the same chart to show the combination of short-term and long-term trends. The Roman numerals represent longer-term waves, while the numbers in parentheses represent shorter-term waves, although there is some overlap. The full spectrum of cycles ranges from grand supercycles spanning multiple centuries to sub-minutes spanning just a few minutes. My God. The Fibonacci sequence is another strategy used to predict areas of support and resistance using mathematics. Developed by the 13th century mathematician Leonardo Fibonacci, the numerical sequence and the ratio between its numbers has been used to describe everything from proportional measurements of the human body to patterns in stock prices. Traders can use these ratios to calculate retracements and a number of other trend lines. In Figure 28, the Fibonacci retracement levels from a bearish move in the S&P 500 SPDR ETF provide support and resistance levels to watch. The index rebounded in mid-2009 from the 23.6% level and reacted 2 more times to the 50% and 61.8% levels. While the Fibonacci tools aren't always 100% accurate, they represent a valuable addition to a day trader's toolbox when it comes to analyzing potential opportunities. Okay. And Figure 28 shows the Fibonacci retracement. These are just 2 additional techniques that can be used in conjunction with other forms of technical analysis to determine ideal entry and exit points. Over time, traders should experiment with these and other techniques in order to discover what works best for them. Quick recap. There are many different ways for day traders to pick stocks, depending on their trading styles and preferences. Discretionary traders often look for volatile stocks in top gainers and losers lists, while systematic traders may look at technical indicators. Technical indicators and overlays provide a statistical indication of when stocks are likely to move in a certain direction. They can be used in the context of a trading system to screen and identify potential opportunities for entry or exit. Volume is one of the most important elements to consider when analyzing potential trading opportunities. It is often used as a confirmation that a trend is beginning or ending, or that a breakout or breakdown is likely to hold. Moving averages are a diverse tool that provides the day traders with insights as to where the current prices lie in relation to its historic norm. In general, the bulls are in control of a market when the price is above the 200-day moving average and vice versa. Elliott waves, Fibonacci sequences, and other sophisticated techniques exist that traders should also explore in order to find out what works best for them when it comes to identifying entry and exit points in stocks and other financial assets. All right. And that completes that chapter. Thank you guys for joining, and I will see you next time.